A whopping 50.95% of David Tepper's Appaloosa management portfolio is in these four stocks. Those four stocks are Constellation Energy at 16.08%, Alphabet at 14.1%, Amazon at 12.04%, and Meta Platforms at 8.73%. The Billionaire portfolio manager is followed by many on Wall Street because of his success over the years, and a lot of investors respect his decisions. So I wanted to kind of look at these four stocks and look at their valuation and try and figure out, what has David Tepper and his Appaloosa management team so excited about these four stocks to make it such a large part of his overall Appaloosa management portfolio. Starting with Constellation Energy and Appaloosa, uh, Constellation Energy trading at a forward price to earnings ratio of 19.37. And of course, energy companies overall have caught a bid in recent quarters as energy prices have soared in response to rising inflation and the Russian invasion of Ukraine. And it's also a benefit because there's limited competition in the industry. It's not like you're getting this rush of energy companies coming out and saying we want to produce more energy. The supply is getting limited, and so when there's a surge in demand and when there's a further shock to supply, like we saw with the Russian invasion in Ukraine, that causes prices to soar, and which causes the industry overall to catch a tailwind. And that could be one reason why David Tepper is attracted to Constellation Energy Corporation. The other stock here is Alphabet Google, trading at a forward PE ratio of just 21, the lowest near the lowest since January of 2022. Alphabet is experiencing slowing growth following the surge in revenue and profits it experienced during the onset of the pandemic as people we're spending more time at home, buying more things online, and that's all a benefit for Alphabet because if you're buying more things online, it makes its digital advertising business more lucrative to marketers, right? They're more interested in paying to show up in Google search results if we're buying more things online, right? Because we're a few clicks away from making a purchase. So marketers are increasing their spending to capture and influence those purchases if they're being made online. If we're spending more of our money on away from home things like restaurants, like bars, and like travel, maybe marketers are less interested in that because they're not certain that your click is going to lead to a purchase, and that's less measurable if you're going to search for maybe a restaurant nearby or a bar nearby. Yeah, marketers are interested in showing up if you're looking to go out to a bar or restaurant, but it cannot be measured as precisely as clicking and making a purchase online. So that's a bit of a headwind now for Alphabet. Revenue growth has slowed down considerably. However, that's a shorter term issue, right? As consumers are unleashing this pent up demand for away from home experiences. Longer term, they'll go back to the normal trend where online sales as a percentage of overall sales continues to grow. That's just a secular tailwind. The advantages of shopping online are far too many in order to neglect. So I can see what has David Tepper attracted to Alphabet at a time where near term it has a lot of headwinds, but longer term the story remains intact. So I like that investment there. The next two, Meta Platforms and Amazon. Meta Platforms, A lot of the similar reasons that I talked about for Alphabet apply to Meta platforms as well. Several near-term headwinds that are impacting Meta platforms' growth and valuation. But one more that is kind of exclusive to Meta and not to Alphabet is the privacy policy changes made by Apple that makes it harder for Meta platforms to sell targeted advertising, and so that's brought its valuation down to arguably the most favorable levels in a decade. So David Tepper here has faith that Meta platforms will figure out how to sidestep these issues and maybe find a solution to that and come out ahead. Again, digital advertising going to benefit from that secular tailwind, more money being spent online, consumers spending more time online. Amazon is a bit surprising to me because of its expensive valuation. The other three stocks that consist of his top four are a bit more favorable in terms of valuation. Amazon trading at a forward PE of 66, way above, nearly more than 3 times more expensive than the other companies in his top four. Although, again, Amazon facing near-term headwinds from the overinvestment in capacity during the pandemic, trying to meet that soaring customer demand, choosing to overinvest rather than underinvest, and now it needs to work through those issues. Again, longer term, gonna benefit from that trend of more money being spent online. So, uh, 3 out of the top four of his portfolio holdings strongly correlated to an increase in consumer activity online and consumer shopping online. So you could see what David Tepper is thinking here. He seems bullish on that trend of e-commerce spending overall to grow, of people spending more time online continuing to increase, and taking advantage of the fact that in the near term, we're kind of not doing that as much because consumers are unleashing this pent up demand, trying to get out more often because we're a bit exhausted from spending so much time at home. So, capitalizing on that near term headwind with a long term tailwind here. So, interesting mix of investments here for David Tepper's top four stocks in his Appaloosa management portfolio. These four stocks, of course, consist over 50% of his portfolio. All right, this was interesting. I had fun doing this video. Thank you for joining me. As always, I appreciate your viewership, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.